I think $100 silver is a very reasonable target over the next couple of years, and it's possible that it really overshoots. So I think, 100 is where you start taking serious profits, but don't sell everything because there's the potential for the next parabolic run. And that could come sooner rather than later if silver breaks into 100, the size of an old silver or $50. But it's worth $4,000 now, and then you think, all right, what does $4,000 worth of silver look like? And it's a nice big pile of beautiful metal sitting on your table,
Is gold being sold off unfairly? Yes, gold should not be down with stocks. But when you look at the fact that there is hot money in gold, there are people who are selling gold now, not because they're bearish, because they're long, and they probably figure they're going to get a chance to buy it cheaper later on. I accuse China of doing what we do, and that is counter propagandizing the markets. They're exporting their propaganda now to us. Am I blaming them? No. That's the way the game is played.
Silver is moving deeper into a phase where physical tightness, accelerating industrial demand, and rising monetary interest are converging. The market remains thin, yet the pressures building beneath it are expanding each month, creating the conditions for abrupt and decisive upside moves. This backdrop strengthens the long-term case for those who position early, rather than waiting for confirmation that will likely arrive too late. John Rubino, a longtime macro commentator, and Vince Lanci, a seasoned precious metals analyst, emphasize that silver's dual identity now matters more than ever. They highlight how tightening supplies, growing stockpiling behavior, and declining exchange inventories are reshaping the market's foundation at a moment when global currency debasement is accelerating across major economies. The deeper trend reflects a shift from optional demand to structural necessity. Industrial users are securing metal in advance, investors are re-evaluating silver's leverage to inflation, and above-ground stockpiles continue to trend lower. In a market this small, even modest capital inflows can trigger dramatic price movements. With monetary expansion accelerating and confidence in traditional safe havens weakening, silver's sensitivity to supply stress increases with each passing quarter. These conditions reinforce the potential for triple-digit pricing, especially if futures markets confront delivery strain or forced cash settlement. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Dollar devaluation play. People have just concluded that we have no choice but to inflate the dollar away, and the euro and the yen and the pound sterling and the yuan. All the big currencies have to be inflated away to cover all the debt that we've taken on. And people have kind of known that in theory for a long time, but now it's becoming more real. And you're seeing the central banks of the world just snarf up all the gold they can get a hold of, and people are taking their cue from those central banks. So there's a lot of gold buying across the board now. And then with silver, silver always had two really good stories. It was a monetary metal attached to gold in a lot of ways, and an industrial metal that we actually really need, and that if it was just an industrial metal, we would still be running a silver deficit that'll turn into a shortage that'll blow the price way up. So I think people are recognizing that too, including the U.S. government that just named silver a critical mineral,
right,
or critical metal, and meaning that the U.S. economy does not function without the metals on that list, and silver is one of them. So now there's going to be a lot of stockpiling where if you make, say, missiles, for instance, or solar panels or whatever, you've got to have a certain amount of silver available in order to meet the orders that are coming in. And you can't just wait until the day before you need it and buy it on the spot market anymore, because spot markets are unreliable, especially for crucial things like silver now is. And so what you're going to do is stockpile. You're going to buy ahead of time. And I think that's a lot of the demand for silver too, is people who might not be using it right away, but they want it to be there when they need it. You put those two things together, and gold is not that huge of a market, but it's much bigger than silver. So with central banks buying gold, that's a wind at gold's back for as far as the eye can see. And with silver, the fact that it's just a tiny little market, it's thinly traded. There's just not that much silver out there, and we're using up above ground stocks at an accelerating rate. So I think there's a real possibility of a silver squeeze here that people have been talking about for a while. And I think there's a decent chance that that's something that happens in some form in the next few years, where the metals exchanges just, start intimating that they don't have enough silver, and then somebody proves it by defaulting and paying out in cash on futures contracts instead of physical silver. And then boom, that's it. Then you get your triple digit silver with a bullet. There's no real upside limit to a tiny, thinly traded market that is suddenly in default. So I think $100 silver is a very reasonable target over the next couple of years, and it's possible that it really overshoots. So I think 100 is where you start taking serious profits, but don't sell everything, because there's the potential for the next parabolic run, and that could come sooner rather than later if silver breaks into 100. Nobody actually knows what's going to happen in the next 6 months, although a lot of people make careers out of those kinds of predictions. But there are very few billionaire short-term traders out there, because it's just very hard to do. What you want to do with any kind of investment, but with commodities in general, and gold and silver specifically, is you just want to be in the on the train that's leaving the station. You don't know when it's going to leave, but you know what direction it's going to go eventually. And you just want to be there. You want to be on the right side of history, which in the case of commodities is shortages leading to much higher prices because of either industrial demand or monetary demand. Uranium and copper, it's industrial demand. They are needed for next generation power plants and power transmission. Silver is needed basically everywhere, but also as a monetary metal. It's the kind of thing that if gold gets too expensive, which for a lot of people it is in a visual sense, like you put a grand in the palm of your hand and it just looks like this small gold coin. It's like the size of an old silver or $50, but it's worth $4,000 now. And then you think, all right, what does $4,000 worth of silver look like? And it's a nice big pile of beautiful metal sitting on your table. So at this point in precious metals bull markets, people normally start doing that kind of a calculation. All right, gold's going to go up, but boy, is it expensive. Look how much silver I can get for the price of one gold ounce. And then people start buying silver. And then you get the parabolic move up because, like I said, it's a very thinly traded market. You get just a little bit of extra generalist money coming into this sector, or at least a little bit by comparison with generalist money, and it'll push silver way up. And I think that's the kind of thing that we will see pretty soon. It might be 5 years, or it might be next week. That's the thing. So you want to be positioned now, because you're hearing all this stuff, right, about different commodities exchanges where the amount of silver they've got on hand is falling precipitously, and it's not clear how much more is going to be left, because more and more futures contract players are standing for delivery. And all you need is one contract on the COMEX to be settled in cash instead of metal, and boom, silver becomes unobtainium, and it goes straight up. So without being able to predict the timing, you can kind of predict the event, and you just want to be there when it happens. So there's no real choice but to get yourself positioned, and then just suffer whatever you have to suffer until it happens. And you're in better shape than a lot of the stackers that started stacking in 1999. Or I'm sorry, 20. Yeah, was it 1990? Yes, it was 1999. Before the beginning of this century, when gold was $240 an ounce and silver was like $4 an ounce. Okay.
Oh man,
lots of people started stacking then, and it wasn't all that long ago. I mean, it's in this century. It's just
it's not that long.
25 years ago.
The recent reversal across markets reflects a decisive shift in expectations as traders reassess rate cut hopes and confront weaknesses hidden beneath the surface of tech-driven optimism. A deep unwind has emerged from the combination of overstretched AI valuations and doubt over an anticipated 50 basis point cut, pushing risk assets lower and exposing just how fragile sentiment had become. Gold and silver, despite temporary volatility, continue to exhibit relative resilience as macroeconomic pressures intensify. Across the broader market, leveraged positions continue to unwind as hot money capitulates and institutional flows rotate away from tech-heavy trades. The breakdown in high-flying sectors is now intersecting with global de-dollarization trends, where accumulating physical demand is playing a larger role than daily price fluctuations. Evidence continues to build that substantial bullion is being sourced through off-balance sheet channels, and the awareness of unreported demand is finally reaching mainstream financial circles. These dynamics are reinforced by sovereign wealth funds, large private entities, and strategic buyers taking advantage of short-term weakness to accumulate physical metal on a large scale. With structural support forming near key price levels, the long-term trajectory for precious metals remains underpinned by physical scarcity, currency dilution, and central bank accumulation. Let's get back to the interview.
You actually have the market saying, oh shit, the Fed may not cut 50 basis points, especially if, this is me talking, if Besant is doing stimulus, I view that as him throwing it out there because he's worried they may not cut. Now, with the Fed 50 basis point cut being potentially rug pulled and the AI concerns out there, well, that's your washout in tech. Now, let's be honest about gold for a second. The last $200, as much as I loved it, were contingent on the Fed cutting 50 basis points. I mean, we're trading $4,000. We're in a big range. We're at the top of the range. Of course I was bullish. Of course I'm long. Of course I'm losing money. But, I'm going to grin and bear it. But staying with the facts, so you have this double whammy out there that's been kind of looming. AI is overvalued. AI is overvalued. AI has got a credit problem. Plus, yesterday, the new thing was, oh shit, the Fed may not cut. And so the combination washed everything out. Is gold being sold off unfairly? Yes, gold should not be down with stocks. But when you look at the fact that there is hot money in gold, there are people who are selling gold now, not because they're bearish, because they're long, and they probably figure they're going to get a chance to buy it cheaper later on. I have to think even macro discretionary took a hit today. And what I mean is they're long stocks, and the stocks are getting slammed, gold's getting slammed, et cetera, et cetera. So when you look at it from that lens, and I'm going to add one more thing. Over the last year, China has been slowly encroaching propaganda-wise on the U.S. American exceptionalism of AI. If you look at Trump as a propaganda artist saying, we're going to have the best AI, we're going to spend the most money, and China's coming back saying we did for $5 million. And China's making more announcements to that effect. We're doing it cheaper. What you're doing is you're making our valuations look too high on the optimism. You show that we are in a bubble. I believe, frankly, I accuse China of doing what we do, and that is counter propagandizing the markets. They're exporting their propaganda now to us. Am I blaming them? No. That's the way the game is played. This is why things are down. Why is it down so much today? Well, something triggered slowly at first, all at once. Michael Burry also closed his short position. I made a joke yesterday. That was probably a bearish sign. Looks like it was. All right. So all of this stuff aggregated is you have a market that had been over its stock market, that's been over its skis, expecting a 50 basis point rate cut. And the lack of data allowed us to delude ourselves to that effect. Now you have Fed speakers, for one reason or another, saying we're not going to cut. There's a good chance we won't cut. And stocks already freaking out over AI, over AI profitability concerns, are just throwing in the towel. So everything is down today. I said yesterday in the morning meeting, I said last night, I said yesterday was a bad thing, but let's hope that the rest of the week closes out well. So this is a Friday. It's a bad Friday. Gold is in a range, okay? 38.80, 39.20 is the bottom. Looks like we have the top being where that top of that ledge was. It looks like we're back inside that area, and so it might be time to put some butterflies on again. All right, so that's it. That's what's going on right now. If you want to read more about that, Zero Hedge has let me see if that's premium. Zero Hedge has a story out called Futures Tumble as AI Euphoria Goes into Reverse. Perfect headline. It's not locked. I would suggest you read that if you want some insight into the stock side of it. All right, so breaking. The FT put out a story yesterday. The FT asserts China's hidden gold buying drove the record rally. As noted in this space, and detailed using proprietary methods, breaking down reports from Goldman Sachs, SocGen, Jefferies, and our own observations, paraphrasing James Rickards several times in this space. Over the last 3 years, China's central bank and related entities appear to be buying far more gold than they officially report, creating a large and opaque source of demand that is closely tied to a broader effort to reduce exposure to the US dollar, and that helps explain the current record bullion prices. Now, it's not news to you. Oh, let me shrink this a little bit. That's my notes on the side there. That's not news to you, but it is news to most of the world that we live in. So that's going to raise awareness. It doesn't matter. Does what's happening today matter? No. Is China not buying today? Of course they're buying. But here we go. China's real gold buying is far larger than the official numbers, according to that new work highlighted by the Financial Times and reinforced by our own multi-year analysis. The PBOC reports small monthly additions, yet evidence from SocGen, Goldman, and London bar flows suggests China may be acquiring hundreds of tons through hidden channels tied to its de-dollarizing strategy. Analysts quoted by the FT, SocGen mostly, say China's true holdings could already be near 5,000 tons. It's more than that. Only 1/3 of global central bank buying is now reported, creating a powerful, opaque source of demand that helps explain gold's record highs. We also noted that only 1/3 of gold central bank buying is being reported now. So 2/3 is not. And it probably has been that way for years. We would remind people that China's army wealth is not on their balance sheet. It's separate from the government. The army and the government are separate. That happens in a lot of countries that aren't liberal democracies. The army is separate from the government. And so when James Rickards used to say, when the army wants to buy gold, that doesn't get reported. They need to make sure they're self-sufficient in the case of revolution, and that happens in China and other places. And the first time this actually was disclosed with some sort of evidence was probably Zero Hedge, a little over 2 years ago, maybe, and Bloomberg right around the same time. But it was Goldman that actually started to show us in their new methodology. It wasn't new, they had it all along, sharing with us how it's done. So that's the story. That was sent out today. It's a very good piece. It doesn't say anything hardcore gold fix people don't know already, but it does frame things in a way that the rest of the world will understand. Of course, it makes China look like an evil player, and of course, it demonizes gold a little bit. But there are some new insights in there. For example, if I can think of them, there is a new insight in there. Special announcement that went out yesterday. Ronnie Stofair, big pullback or peak. Very nice slideshow. We're going to ask him for the video if there is one of that, because that was a keynote address. GoldFix PM, you saw that. Tether hires HSB Gold Traders and Founders AM First Look Special. Coming soon this weekend. Citibank notes there is not enough physical gold for the coming demand, period. That's their way of looking at things, and it makes sense. We've looked at that, and we're going to break it down for premium over the weekend. The bad news is we went back below that area. Shit. Look at that. That ledge, like an evening star type of thing down. So now we're looking at this here. Now, I don't expect this to hold, okay? I've already come to terms with the death of that line. I want this to hold, which is 3,900. If we stop here and go back up, that's great. In fact, we're probably being bought right now by sovereign wealth funds, by central banks. That's what it was. The FT said they and SocGen are talking more about who else is buying. It's not just central banks, which we know. It's sovereign wealth funds. It's entities that are off balance sheet, like the military. That's what they were saying. Anyway, I'm Vince. It's Friday. On the week, we're doing much better. Here's the zoom out thing. On the week, there's the S&P chart for the week, right? What is that on the week? I don't have the percentages up there. So that's 67.40, 66.70. So it's down 10% on the week. Is that 10% or 1%? 1%. And gold is still fucking green. Okay? Shitty green, but green. Silver, may still be green as well. It has to be, right? Yeah, still green. So the trade is, as I didn't do, but I said I was going to do, is short tech and buy miners. That's the trade. And when everything bottoms, then you just buy your tech back. You don't sell your miners.
Market conditions continue to shift rapidly as risk-heavy sectors unwind and traders reassess the sustainability of recent optimism. The combination of stretched valuations, tightening financial conditions, and renewed uncertainty over policy moves has forced leveraged positions to unwind across multiple asset classes. Precious metals, despite momentary turbulence, remain supported by deeper structural forces tied to global liquidity stress, currency erosion, and accelerating physical demand. This environment is drawing long-term buyers into gold and silver each time prices dip, strengthening the foundation beneath the market. Strategic accumulation continues in the background as institutional capital, sovereign entities, and private wealth reposition toward hard assets. These flows highlight a growing recognition that traditional safety nets are eroding, making tangible stores of value increasingly essential. With physical demand quietly strengthening and macro pressures unresolved, the setup for metals remains constructive even in choppy conditions. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.